Good morning, everyone, and thank you for giving me the opportunity to discuss hedging alternatives for the mining community. My name is Anthony DeMartino, and I recently joined Matrixport as the U.S. CEO. Prior to Matrixport, I was the CEO of Coinbase Risk Strategies, a DeFi and derivative trading subsidiary of Coinbase Inc. In that role, I was responsible for building out trading products to help clients earn yield, hedge, and gain access to the crypto markets. Prior to joining Coinbase, I was a managing director and head of trading across multiple asset classes, including emerging markets, interest rates, credit, and derivatives, at firms including UBS, HSBC, and Barclays. I mentioned my prior experience because it's prepared me to help clients navigate the environment we're currently in. Being on the front lines of the global financial crisis, Eurozone debt crisis, and most recently, the currency crisis in Argentina, these experiences have helped me formulate strategies to focus on what's most important. Strategies to not only survive the turbulent markets, but make the moves to ensure that you're set up for the next bull run. Before we go any further, I think it's important to spend some time on how we got here. The global macro market is going through one of the biggest upheavals in the last 40 years. While people like to point to the global financial crisis as the closest comparison, I believe the more accurate comparison is the energy and monetary crisis of the late 70s and early 80s. We're experiencing many of the same hyperinflationary effects that we saw back then. The current US Federal Reserve, or Fed, looks to be following the same path as the prior Fed president, Volcker, during that period. Through a series of aggressive rate hikes, pushing rates to over 20%, Volcker eventually raised rates enough to curb demand, thus pulling down inflation to more manageable levels. I believe the current day Fed is embarking on the same path, with the goal of curbing demand to bring down inflation. Unfortunately, while the Fed is powerful, their inflation-fighting tools are limited and blunt. As we come out of the COVID crisis, it's clear the shape of the global economy has changed. Fed by restrictions from the virus, government handing out extraordinary amounts of cash, shifting political ideology, shifting consumer demand and supply disruptions, the world is going through the most inflationary period in the last 40 years. The biggest driver of inflation currently is energy costs. These costs are being driven higher for a number of reasons and are spilling over into the cost of other goods and services. These drivers are not easily reversed, resulting in prices remaining sticky for quite some time. First, there was a political ideology shift towards a more green economy, which lifted politicians to power around the world. Unfortunately, the current energy production was not set up to handle such a drastic shift in such a short period of time. Second, the decisions to shut down pipelines, power plants, and other fossil fuel generation created supply chains that cannot be easily reversed. Adding to these factors is the Ukrainian war, which took many by surprise. Furthermore, the response by Western governments was stronger than originally anticipated, especially from the Eurozone, which relies heavily on Russia for energy. The region has been unable to secure enough alternative sources of energy, thus is experiencing exponential price rises in both food and fuel. A change in course will be difficult, so in our view, we will be in these challenging times for quite a while. The Fed, facing this reality, is heading into a politically sensitive time in the US. With midterm elections only a few months away, they have limited options. Inflation, especially focused on food and fuel, is a tax on everyone, but disproportionately on the economically disadvantaged. These are people living paycheck to paycheck. Very few are impacted by a big drop in the stock market, but everyone is impacted by an increase in fuel or food, and they will vote. For these reasons, we believe the path is set. The Fed will use rate hikes to get inflation under control, which will lead to a material drop in growth, asset prices, and finally could lead to a recession. While the approach will surely slow down gross consumption of almost all goods, the prices of items that we consume on a daily basis will come down much slower. This will create an environment where the economy will slow, yet the cost of daily life will not change. This will not happen all at once. The economy is still buffered by an enormous amount of cash, which was deposited and hoarded during the COVID era. Furthermore, we are seeing much less equity capitulation than we saw at similar points in market downturns. This is what's giving more bullish investors hope that the economy has enough in reserve to engineer somewhat of a soft landing. This belief has led to the recovery we are seeing most recently. Being in the depths of the summer doldrums and outside of the Fed meeting today, there's very little new information that's coming in the pipeline in the next couple of months, so we expect the market to tread water during this time. Moving on to the crypto markets, where we have seen a nice rebound off the panic lows in June. It seemed like every day another lender was going under, while traders were speculating who had the most unsecured exposure. The market rout was kicked off by a spectacular failure by Terra Luna. This led to the downfall of many companies and projects who were unprepared or lacked proper risk management. Personally, I think the crypto industry is getting too much bad press for these decisions, specifically in counterparty and liquidity risk management. I experienced many of these same mistakes in the run-up to similar market upheavals in the credit, mortgage, and equity markets over the last 20 years. Either way, the results are the same. Fear led to panic, panic led to a liquidity crisis, and a liquidity crisis is what drove good and bad firms out of business. The panic has subsided, stabilizing markets on the back of a few key bailouts and exhaustion in selling. In my opinion, one of the biggest factors to the crypto relative outperformance in recent weeks is the announcement of both 3 Arrows Capital and Celsius going into a controlled restructuring. These were the elephants in the room, which many had feared would continue to dump positions to raise cash, adding to the uncertainty and volatility of the market. Now that both are in the process of formally restructuring, the market can breathe a sigh of relief because they're unable to sell these positions in the short term. Furthermore, there's optimism around the progress being made towards the ETH merge. This has helped draw in fresh capital and stabilize the market. Again, like the global macro situation, I think this is a short-term reprieve. Crypto, while trying to claim it's more than just a risk asset, i.e. an inflation hedge, has failed to back it up during this downturn. So for now, it's hard to see crypto rally without a more broad-based economic recovery. Since I'm not bullish on global macro, it's hard to be bullish on crypto at this point, and I think at best we're looking at a sideways market. Now, with that said, and the scene for the market set, and expectations for crypto prices, let's move on to mining specifically. For this part of the speech, I'll refer to Bitcoin referring to mining. As you all know, for companies currently running mining operations, Bitcoin and electricity prices are the most important and volatile variables of the equation between profitability and sustainability. Both of these factors have moved away from the mining industry, which has put stress on many business models. For those of you who have been fortunate enough to secure long-term power deals, you have one less thing to worry about, depending on how long the current energy situation exists. Either way, liquidity is vital to managing market turbulence. The market will normalize as it always does, so it's prudent to closely manage cash and debt to make sure you make it to the other side, putting yourself in a position to benefit from the next bull run. The community has continued to become more professional, institutional, and savvy. The idea of hedging and liquidity management has come up much more in conversations, and at its heart, the community is a believer in crypto and thus long-term bullish. This is a clear bias and needs to be respected when suggesting risk management solutions. So the topic for today was to discuss hedging strategies for the mining community. When coming up with these options, I went through the process of evaluating the market environment, identifying key risk factors, and factoring in the core beliefs of the community. With all that said, I believe there's ways to manage the current situation as opposed to trying to hedge. Unfortunately, the time for hedging is past. We are now in an environment where I believe the best strategy is to raise cash while maintaining upside exposure to Bitcoin. Furthermore, I see a couple of ways to achieve this goal. One way, if you have enough BTC liquidity, is to borrow against your Bitcoin via collateralized loans. I understand the market has been disrupted lately, but we've seen a loosening in terms recently that are becoming much more favorable to the mining community. This is a higher risk strategy as a continued fall in prices will require more collateral for the same amount of cash. I would only suggest this strategy to clients with significant BT reserves and strong bullish conviction. The second strategy I suggest is to raise cash via outright sales and use a portion of that cash to buy upside calls. In this strategy, you're less exposed to a significant drop in the Bitcoin price, but you do retain some upside if the market recovers. This is a bit more complicated than the first strategy, as it requires a client to choose how much upside exposure they want and for how long. All things we at Matrixport are equipped to help you with. We at Matrixport stand ready to help the hedging, lending, and capital needs of the mining community. Matrixport is a global, leading one-stop cryptocurrency services shop offering a wide array of products from custody, asset management, spot trading, and prime brokerage, reaching 150,000 clients in 40 countries. We are now focusing on expanding into the United States, recognizing the US has become the global leader for Bitcoin mining and the #1 by hash rate. As many of you know, we are founded and led by Jihan Wu, one of the pioneers of the mining industry. Along with Matrixport, he's also founded our sister company, Bitdeer, making him a true crypto native, deeply aware of his roots within the mining community and always mindful of your needs. If I were to sum up our relationship with the mining community in one word, it would be symbiotic. It's a relationship where we have worked to support your ventures, your capital needs, and have developed specific products to help achieve your financial goals. We have a commitment to continue to build and grow even in difficult times. By working with us, you will find that we always have your best interest in mind and treat your assets with the utmost care, transparency, and security. I just wanted to finish up today and thank you for your time. Again, we at Matrixport stand ready to support the needs of the mining community during this difficult time. We are actively looking to lend, offer advice, and create products to hedge and generate yield. The new US team brings with it a wealth of experience in debt restructuring, and by partnering with our sister company Bitdeer, a leader in the mining space, we are able to help projects find additional sources of funding and liquidity. So in situations where difficulties arise around liquidity, we are now in a position to help with debt restructurings and alternatives. Please feel free to reach out to me specifically or anyone on my team, and I encourage you to stop by our booth. Thank you very much.